How to combat inflation. You've probably heard that word more than you would have liked in the past year. I can attest to that, but instead of sensationalised headlines and mathematical calculations, let's cut to the chase. What does it mean for you, and what can you do to combat inflation? The official word in the beginning suggested the current inflation we are seeing was transitional as economies across the globe reopened and demand for goods and services increased more than the available supply. In recent months, the official word has shifted. Surprise, surprise. And it looks like we will be seeing higher inflation for longer than was initially expected. Inflation isn't necessarily a bad thing for the general population. Workers ask for raises and borrowed money becomes comparatively less valuable. It can, however, be extremely damaging for savers and retirees as inflation erodes the purchasing power of every dollar. Retirees typically need two things out of their savings. One is safety, and the other is income. Let's look at 4 strategies you can implement to combat the effect of rising inflation. Number 1, move your stock holdings from growth to value. In recent years, growth stocks, especially in the technology sector, have outperformed value stocks. But that could be about to change. Why? Because growth stocks have much of their earning expectations in the future. Growth investors look for $100 stocks that could be worth $200 in a few years if the company continues to grow quickly. Low interest rates help fuel this growth. Higher interest rates make this growth more difficult to achieve. Value stocks, on the other hand, are usually more established but undervalued companies and tend to take rising interest rates in stride. Number 2, reduce allocation to traditional bonds. Bonds and interest rates have an inverse relationship. When interest rates go down, the value of the bonds go up. On the other side, when interest rates rise, the value of the bonds go down. The fluctuations increase the longer the term of the bond. I am sure you are truly on the edge of your seat with that revelation, but hear me out. Retirees and those getting closer to retirement age typically have a sizable allocation to bonds in their portfolio. If interest rates rise as expected, you could well see negative returns in this part of your portfolio in the coming years. What should you do instead? At Bellwether, we have a unique approach to fixed income, which includes preferred shares, our alternative lending strategies, infrastructure, and keeping our allocation to bonds short-term in duration. We are well positioned to take advantage of rising rates. Number 3, invest in gold or commodities. Commodities have long been seen as a hedge against inflation because commodity prices typically rise when inflation is accelerating. This sector is also likely to get a boost from huge potential infrastructure plans in the US and China. Number 4, increase real estate allocation. Real estate provides natural protection against inflation because physical assets tend to increase with inflation, but also because property owners increase their rents to offset price rises. The problem with Canadian real estate, though, is that prices are already complete and utterly insane, so there are additional risks that need to be considered. So there you have it, 4 solid ways you can protect yourself and even benefit from rising inflation. If you're interested in any of the strategies mentioned today that our clients at Bellwether are currently benefiting from, reach out and book some time to chat with me. Hopefully you found this video useful, and before you go, please hit the like button and subscribe to the channel.